Okay, ladies, we're live. Okay, thank you. We're live.
Thank you. Yvette, you can go ahead and get started. Angela, if you could let participants in since I'm no longer co-host.
Yes, sure.
You want me to wait till?
No, go ahead.
You want me to go? Okay. Good evening, ladies and gentlemen. Welcome to the National Coalition of 100 Black Women, Northern Virginia Chapter, Economic Empowerment Committees.
I'm sorry, Yvette, your paper is in the way.
Is it? I'm sorry. Is it in the way now?
No.
Okay. Sorry, Economic Empowerment Committee Financial Literacy Workshop entitled More Money, Less Problems, an introductory course in financial and insurance strategies to secure your future. Hello, my name is Yvette Jefferson, and I serve as the chair of the Economic Empowerment Committee. At the end of 2020, the Economic Empowerment Committee was awarded 2 grants from our national chapter, one from the Coca-Cola Foundation and one from the Truist Foundation, which is the sponsor of this event. These grants were for our chapter to develop programs focused on financial literacy, family wealth building, and entrepreneurship. We were to include comprehensive workshops and seminars that promote economic self-sufficiency. The National Coalition of 100 Black Women is comprised of African-American women who understands the power of collaboration and the need for commitment to serve in order to make real difference in the communities we serve. As we close out our calendar year 2021, the Economic Empowerment Committee of Northern Virginia Chapter hopes that we were able to provide you with powerful information that has helped you build wealth, financial wealth. And we thank you for all of your support. Additionally, I would like to take this opportunity to thank my Economic Empowerment Committee team. I'd like to thank Ebony, Jackie, Tamara, Sandra, Stacy, Cynthia, Gail, Pam, Portland, Beverly, and Gina. I would also like to thank the tech team, and I would like to thank our immediate past president, Sheila Bryant, and our immediate past first VP, Angela Smith-Mackey. All of our sisters of the National Coalition of 100 Black Women, Northern Virginia Chapter, and I'd like to thank you, our supporters, and our beneficiaries of our workshop, along with our incredible presenters. Because of you, we were able to win the 2021 Economic Empowerment Award from National. So thank you, each and every one of you. Now tonight we have 2 dynamic presenters who are going to provide you with some basic understanding about insurance and finance. We have Mr. Xavier Collins of Farmers Insurance and Ms. Dawn Edgerton Cameron of Edward Jones. Now I will turn the program over to Ms. Jackie Mitchell. Thank you.
Greetings. My name is Jacqueline Mitchell, and I am pleased to introduce our first speaker for this webinar, More Money, Less Problems. Mr. Xavier Collins is a captive agent of Xavier Collins Farmers Insurance Agency located in Lilburn, Georgia, and has over 20 years experience as a licensed agent in the state of Georgia. Mr. Collins understands the unique complexities that come with insuring your home, car, or business. He uses his expertise to help make his clients smarter about insurance options, whether that be auto, home, business, life, insurance, and more. Xavier Collins Farmers Insurance Agency emphasizes educating their customers on all the ins and outs of their coverages so they know exactly how their coverages will perform in case of a loss. Mr. Collins has prepared a thoughtful presentation that you will find informative and useful in your insurance needs. Now, I will hand it over to the capable presenter, Mr. Collins.
Xavier, you're on mute.
Can you hear me now? That works when you're on mute, doesn't it? I'd like to thank Jackie Mitchell for that warm introduction, as well as the National Coalition of 100 Black Women of the Northern Virginia chapter for the opportunity to present to you all today. My objective is to give you a clear understanding of insurance, and the objective of insurance is to finally guard against unpredictable life occurrences. In short, when you buy an insurance policy, you make monthly payments called premiums to purchase protection and monetary repercussions related to things like accidents, illness, or even death. So our objectives for this presentation today is for you to become smart about the things you value the most, how to protect your assets, and the understanding of life insurance. How to protect those things that you value the most, such as property insurance, auto insurance, umbrella, and life insurance. And after we go through each one of these segments, I'm gonna open it up for questioning, so you can chat your questions in, and the representatives who will be reading the questions back, and I'll respond to those accordingly. However, we'll have to limit those for the sake of time. So the first discussion we're going to talk about this evening is going to be property insurance. And I've prepared an example, and I'm actually going to go through this illustration here just to give you a clear understanding in the event of a home loss, how your insurance would perform. So if you look here at the coverage A, which is your dwelling, and that is what on this particular property that it will cost, that insurance will pay in the event of a loss. Now,
Excuse me, Xavier, can I interject for a minute? Your presentation is not in, your PowerPoint is not in presentation mode. We just see your intro screen.
you can't see my presentation?
We just see the first page.
All right, hold on 1 second. What about now? What about now?
No, same thing. It's not in presentation mode.
Hold on 1 second here. Why is it not in the presentation?
There you go. We can see property coverage information, that slide now.
You can see it now?
Yes.
Not sure what happened. I had to close that and go back in. Okay, so we're going to start at the under coverage A, which is the dwelling. So in the event of a loss, the insurance company will pay up to $956,000 to replace this property. Then it also has 10% of extended replacement costs, which means if there's an increase in building material of such, they would increase that 10% of the dwelling cost, which is an additional $95,600. Coverage B is separate structures. That's anything that's detached from your property. That's covered at $95,600. Coverage C is your personal property. That'll be your furniture, your clothing, your appliances, anything that you would take with you in the event you should move. That's covered at $525,800. And this is a total replacement policy. Now, not all policies are written on total replacement. Some of them are written on actual cash value. This particular policy is written on replacement cost. Coverage D, in the event you have a loss and you can no longer live in the property, you have to continue to make your mortgage payment. So therefore, the insurance company will pay up to $191,200 so you know the place to stay while the house is being repaired. Most situations, they try to have that home repaired within 12 months. Property limit on mold. Now, mold is an optional coverage. You can purchase additional mold coverage. Most homeowners policies come with $5,000 of mold coverage. On this particular illustration, we've increased the mold coverage to $47,800. Personal liability, which is a very, very important product on this policy. And as Dawn Cameron will discuss with you all later on about building wealth, protecting your liability assets is very important. So this homeowners policy, and this is actually standard, probably is the most least utilized coverages on this policy, is covered at $100,000 of liability insurance. And if you notice to the left of that, it's an optional coverage. You can't increase that, but $100,000 is only $57.92 a year. So that particular liability coverage is not very expensive at all. And then MedPay, so if someone comes over your home and they're injured, we'll pay their medical bills up to $1,000 per occurrence. And then you got liability limited mode coverage of $50,000. Now the $47,000 that I spoke with you earlier, that's an additional to that's liability. So the $47,800 that I spoke to you about the mold coverage, that actually to repair or replace any damages to your property as a result of mold. The liability limits is if someone is visiting you and they get sick or something happens to them as a result of being exposed to mold, that's an additional $50,000 limited mold coverage that you have. Identity fraud protection comes with this policy, which is $1,500. And then you got building orders. Now, I'm not that familiar with Virginia or other participants may be able to call and what happens in your state with building codes, but in the state of Georgia, they change quite frequently. So in the event you have a loss and you have to pull a permit, and the inspector requires that you update electrical, the plumbing of something of that nature, that can be an additional cost. So in addition to rebuilding the property, so on this particular policy, we would give up to $95,600 to bring the property up to the building codes. And then you got limited match coverage on this policy. So let's say hypothetically you have a loss, but it's not a total loss, and you have siding on your house and they don't make that siding anymore. The insurance company will pay up to $10,000 to try to match that siding as close as possible. And then on this particular policy, which is especially in the state of Georgia, not familiar with in Virginia, but this is a very, very important part, is building material and loss settlement. You want to make sure that on your policy you have roof replacement, because depending on the size of your dwelling, that could be a very out-of-pocket expense if you have what is called actual cash value. And let me touch on actual cash value for a minute. Actual cash value is they depreciate the age of the property versus what it will cost to replace it, and they will give you that. So let's say you have a roof on your home and you have actual cash value, and the replacement cost on the roof is $10,000 on a 20-year shingle, and you have ACV, well, and you've had that roof for 10 years, they would depreciate that roof by the number of years you've had it, so which then you would only get $5,000. Now you're out of $5,000 addition to replace your roof. So I don't suggest that you ever consider ACV on your roof. And then on the next slide, you got your personal property at the second residence. So let's say, for example, you have clothing stored at someone else's home and that house burned down, then you have extended replacement costs to your second residence of your personal property. And if you notice, it's 10% of what the personal property on your primary property, so up to $52,580 on this particular demonstration. Now, theft of jewelry, watches, and furs. Now, this is another very important area, because I know you ladies like to have nice jewelry and things of that nature. But on this particular policy, in the event of a loss with your jewelry, they would only pay $1,000 per loss, and then a max of $2,500. So what that basically means is that in the event you have a piece of jewelry that exceeds $1,000, they only going to pay $1,000 as the max they'll pay for any single piece, and then a total of $2,500 per claim. So my recommendation is that if you do have additional, you can increase these limits above this amount. However, it never increases the $1,000 for a single piece. So if you have a piece of jewelry that exceeds that amount in value, then my recommendation that you list it on your policy as a floater. Most insurance companies will require that you have an appraisal, and it's usually not very expensive. And then the other coverages, and I'm not going to go into each one of these individually, but if you look, I'm gonna give you a second to look down the list of just limited. And what that is limited coverages on these particular losses. Now, I want to go back up to the previous slide just for a second and direct your attention to personal property. So if you look under your personal property, you've got $525,800 of coverage on your personal property. But if you go back over to this slide, you notice where there's limits of how much you can have on those particular items. So just because you have $525,000 of personal property coverage does not necessarily mean that you're going to get that amount, because they've got limited coverages on these items only. Now, if you notice, it's not in your daily wear, it's just certain items that they're limited coverages on. All right, and then on this particular policy, there's a $1,500 deductible. And my recommendation to you is when you're doing your insurance, I would never carry less than $1,000 deductible on my homeowner's policy, because the deductible is the amount of risk that you're retaining. So if you know, let's say if you say, I only want a $500 deductible on my homeowners. Well, I mean, look around your home and just think about it. If, you know, your screen door get cracked, are you going to call your insurance company to file a claim and have them to replace your screen door? Probably not. So my recommendation is we at least have a minimum of a $1,000 deductible on that. So that pretty much concludes my presentation on the homeowners policy. And what I'd like to do at this time is open up to see if there's any questions about homeowners insurance.
Yes, Mr. Collins, we do have a question in the chat. Jessica Brown says, does farmers insurance offer business insurance, also cargo liability insurance for freight brokers?
Farmers insurance does not offer cargo insurance on the farmers. However, a farmer's agent can still do cargo insurance for you. It just won't be written under the farmer's brand. And what was the other one? Other type of insurance?
Does farmers insurance offer business insurance?
Yes, we do offer business insurance. However, that is limited, but farmers insurance is also in what is called a noodle with Kraft Lake. So anything that farmers insurance brand does not write, a farmers insurance agent will be able to provide that coverage for you.
Okay, and that was the only question that was in the chat.
Okay. All right, well, if there's no additional question, we'll move over to the automobile insurance. So on the automobile insurance, you have liability, and then liability helps pay the cost of injuries to others and damage to their property when you're at fault. This coverage is required by law in nearly all states. And then you have collision, helps cover the cost to repair or replace your vehicle. When you're at fault, it covers collision with other vehicles, objects, and animals. And then you got your personal injury protection. And this is only for those folks on the call that's from Maryland, or I don't know who else may be on the call, but you want to check for your state. But under Virginia and Georgia, we don't carry PIP, but personal injury protection help covers the cost of your rehabilitation and lost wages as a result from an accident, no matter who's at fault.
Excuse me, I'm sorry, Mr. Collins, can you advance your slide? You're still on the residential property.
I don't know what's really going on because on mine, I am on the slide. I don't know why it keeps doing that. Let me see here. Is y'all there now?
I still see residential property.
Not sure what it's doing. Let me know if it's changing on your side. I'm not exactly sure why.
Mr. Collins, you may have to stop sharing and maybe try it again.
Okay, give me just- What about now?
Yes. Mhm.
You see it?
Yes, I can. Mhm.
Okay. All right, I'm just gonna leave it in this mode then because I'm not sure what's going on. Okay, so under, I'm gonna start over because make sure you all follow me. So on the liability, helps pay the cost of injury to others and damage to the property when you're at fault. This coverage is required by law in nearly all states. Collision helps cover the cost of repair or replace your vehicle when you're at fault. If it covers collision with other vehicles, objects, or animals. Personal injury protection, which is in the state of Maryland, helps cover the cost of your rehabilitation and lost wages resulting from an accident, no matter who's at fault. And MedPay, which is in Virginia and Georgia, only pays your medical bill. The difference between the two, in the state of Maryland, under the PIP, and I also know that's in Florida, it also can cover your injuries as well as lost wages. In the state of Georgia, it's only utilized for medical payment. And then comprehensive coverage covers your vehicle for the loss caused by things beside a collision. This includes theft, vandalism, hail, fire, and animal damage. Now, one of the things I want to cover under your comprehensive, and this will be a question I'll pose to you all. In the event someone breaks in your car and steal your computer, which one of these coverages would cover your computer?
So if you have an answer, you can put it in the chat.
Well, I'll just cover you. That would not be covered under your automobile insurance. That would be covered under your homeowners, under your personal property. And if those of you all that do not have a home policy but have renters insurance, you may want to check and make sure your renters insurance policy covers your personal property away from your residence. All right. So-
Mr. Collins, I'm
Yes,
just gonna
ma'am.
let you know, I have your slides and I'm gonna take over sharing, so I'll run your slide. Just tell me when to advance them, okay?
Thank you very much.
Oh, you're welcome.
Thank you so much.
Mhm.
Mary, that's you?
Yes, that was me.
All right, thanks a lot. Okay, so looking at the illustration under the automobile policy, now this is very, very important. And it's going to be more important as you talk with Dawn Cameron, as you talk about growing your wealth. This is very important so that you protect those assets. So in the bodily injury, so in the event you're in an accident and you're at fault, on this particular illustration, your insurance company will pay $100,000 for the first person's injuries, $300,000 total accident. Now, this is a pretty good coverages on this policy. In the state of Georgia, most states, the minimum liability limits is $2,550, which means that the insurance company will pay a max of $25,000 for the first person's injuries, $50,000 total accident. Well, if you're in an accident and there's 3 people in the car and everybody said they're injured, more than likely you're not going to have enough insurance to protect you. And you're going to receive a letter from your insurance company saying we've exhausted your liability limits. You probably want to seek legal counseling. So make sure that you clearly understand those limits there. And the next one is property damage liability. We'll pay up to $100,000 for any damages that you may cause to the property. Uninsured motors. Now, in this particular category, and I do recommend you check it for your state, this covers your vehicles. Let's say hypothetically someone hits you that does not have any insurance or does not have enough insurance. Now, on this particular illustration, so let's say hypothetically someone hits you that has state minimum limits and you're driving a brand new Lexus and the property damage on their car, the max they'll pay out is $25,000 for your brand new car. Well, you can go up on your uninsured motorist coverage, but there's an additional column that you do not see here. That's called reduced by, and there's another one called add on. What that means is that in the event you are in an accident hit by someone that does not have enough insurance, they will reduce your policy by the amount of insurance they do have. Add on means they would add it to the amount of insurance that you do have. So in this particular situation, let's say someone hit this insured that has state minimum limits, and they are driving a brand new Lexus, and the car's total, and they have reduced by. This policy will be reduced by $25,000. So the max they still only have covered on the vehicle between the two policies is $50,000. So my recommendation, if you don't want to have the add-on, at least increase these limits. And if you look at the coverages right here from uninsured motorists, let me use mine. If you look at the cost of what insured motorists cost versus what liability and property damage cost, is very minimal. So this probably would only go up maybe $15 if this was 100, 300. Okay. And I actually was speaking more down here about the property damage. This is the medical side of it. So if they don't have any insurance or not enough insurance, this is how much additional medical coverages you would have. However, you know, you also, if you have health insurance, that also would play a major role once these limits are exhausted. And then you go down to accidental death indemnity. Now, farmers insurance policies come with the $5,000 accidental death insurance. Then that, if you notice, it's included in the premium. You don't pay anything additional for that. And then there's towing involved. Towing, if you look at this farmers insurance, we offer up to $150 per occurrence, and you can have 3 within a calendar year for $8.80. So I would always include that in my coverages. Don, can you slide to the next one? Don? Hello, you're still there?
Yes, I advanced your slide. Can you not see? Do you want it down past payment options?
Oh, you can leave it there, payment options, I'm sorry.
Okay.
So if you look here at payment options, this is not much detail, but if you notice between the term premium, if you look at the one pay, the premium is $2,004.30. If you do two pay, if you look and see where the increase in amount. So if you can pay one pay, you're always going to save money. However, I do recommend that you do automatic payment, because if you go down and look at credit card and monthly, those amounts are a little bit higher than if you do it with an automatic come out your checking account. For example, EFT on this particular policy is $344.55 a month, versus if you're taking off a credit card, it's $361.79. And then if you're calling in making a payment over the phone, it's $325. But if you notice the initial installment for calling in, paying it over the phone, you're paying $542.70 to get it started, although your monthly payment is a little less. But if you look at the premiums equivalent to credit cards, so the most economical way to go there would be the EFT or one pay. Okay, so that includes auto insurance. And what I'd like to do is open up to see if there's any additional questions or any questions.
At this time, there are no questions in the chat.
Okay. All right. Okay, John, so we're going to move over to umbrella insurance. Now, umbrella insurance is what extends your liability limits up to $1 million. However, it is required that you have your underlying limits at $250,000, $500,000 in the state of Georgia. Don, can you go back to the auto insurance just for a second? Right. right there. So when, right here where it says bodily injury, these limits would have to be 200, 500,000, and then the property damage would be found on this particular policy in order to have an umbrella policy. Okay, all right, Don, you go back to umbrella. And what an umbrella policy does, it extends your liability limits up to $1 million. So in the event you're in an accident and you're being sued, you have up to $1 million to protect your assets. For those that have young drivers that's on your policy, these are very, very critical. I had one of my previous customers' daughter went to pick up her boyfriend from a club, and I don't know what happened. You know, as I tell you the story, you're probably going to fill in the gaps as well, but she ended up running into him, pinning him up against the wall. He lost his leg. So umbrella policies would be needed in a situation of such. And one of the things, if in the state of Virginia and Maryland, if it's like Georgia, in the event you're in an accident, everybody sues. So as you're growing your financial wealth, make sure that you consider an umbrella policy in protecting your assets. Or if you're a business owner, an umbrella policy would be very, very important, because what happens in the event of an accident, the attorney looks at who was the guilty party, and then they look at what assets you have. And then that determines the amount of injuries that the other person had. Okay, so if there's any questions about umbrella policy, that will include the umbrella section.
No, no questions, but someone did make a comment that they don't believe that was an accident.
I knew somebody would have.
Right.
All right. Okay, why life insurance? Out of all the coverages that I've went over and discussed with you all, this is the most important coverages that I'm going to talk about. And the reason being is that you may not ever have a home claim. You may not ever have an accident claim. You may not even never have anyone that sues you. But one of the things that we all know is that we all are going to die. Life insurance is what protects your family in the event that you pass away. And I take this particular coverage very, very serious to all my customers. And the reason being is that if anybody passes away uncertain and the family don't know if they have life insurance, I'm going to be the first call. And so I always post to my customer, your family just came to my office. What do you want me to tell them? So this is a very, very important aspect. So Don, you can slide to the next slide. So term life and whole life. And what I'm going to do is explain to you the difference between the two. Term life is for a period. For an example, you just got married, you and your husband bought a house. You sit down and say, well, and you're having kids, and you say, you know, if something should happen to you or something should happen to me, prior to us paying off this house, prior to the kids graduating from college, we need to have something in place to cover that. Well, term is that's for a term. If you got a mortgage, it's 30 years. So, you know, if you get life insurance to pay off the house, 30 years later, the house is paid off, there's no need for that. If it's for it to make sure the kids are able to go to college, if you pass away prematurely, they're going to eventually reach the age where they're beyond college age. That's term. It's cheaper insurance. There's various type of term life insurance. You have one where there's a impairment involved, and there's one where there's no impairment involved, which is called a simple term. However, the simple product does have a 2-year contestability clause, which means that if you falsify the application, for example, you have high blood pressure, you said, you know, on the application, I don't have high blood pressure, but you pass away, because you had high blood pressure, then the policy would only pay what you would have been able to obtain with high blood pressure. For an example, for the sake of math, let's say you are paying $50 a month because you say you don't have high blood pressure. You would have been paying $70 a month. Well, let me back up. So let's say you have $100,000, you're paying $50 a month, and because you just say you don't have high blood pressure. If you had told them for $70,000, I'm sorry, for $70,000 for $100,000, you'd have been paying $70,000 for $100,000 of life insurance. You pass away and they found out that you did have high blood pressure, they would only pay your family what $70,000 would have provided for you had you told them. And if $70,000 won't provide any coverage, any amount of insurance, they will reimburse your family the premiums paid. And as long as you pay the premium, a term life insurance, you have to get it by the time you're 70 years old. And typically it's up at 90 years old. So most people don't have it beyond the 90-year period. But just remember, it's for a period. And to be honest with you, it's not really designed to pay. You know, most insurance company hopes that you outlive the term of the policy. Okay. All right. Now, whole life. Whole life is a lot more expensive than term life insurance. But it's exactly what it says, is for your whole life. And it's designed as long as you pay your premium, in the event you pass away, your family would be paid the face amount of the policy. If you live to be 100 years old, on most policies, the policy endows, and which means the insurance company will send you the face amount of policy plus any interest that accumulates. And whole life insurance does accumulate cash. However, when you utilize it for a financial vehicle, just remember the cash that's in that policy has to be borrowed against, or you have to surrender the policy in order to retain the cash out of there. Dawn probably got some products and things that she would talk to you more in detail about, where you know, it's a vehicle that works on both sides to provide investment as well as life insurance. And I think I talked to you yesterday. I'm not sure if she did that side, but there are policies out there that do that. One of the things I want you to understand about all insurance, when you take a policy, make sure that you have leveling terms. There's decrease in terms and there's increase in terms. You don't want to get a life insurance policy as you get older, the premiums start going up. You want to make sure that's at leveling terms, which means that at the time you take it out, it will remain that rate until you either pass away or you cancel the policy. And all life insurance is based on your obtained age. So if you're in your early 20s, mid 30s, take out as much life insurance as you want now, because as you age, that insurance will increase tremendously. However, the death benefits is in addition to the cash value. So whatever cash accumulated in the policy, your family would be given that, and to include the cash that accumulated in the policy. Now, one of the things I would tell you, our lives take many different changes. One of the things to make sure, as well as keeping life insurance, you also stay on top of your beneficiaries. If you go through a marital change, make sure you change your beneficiary of your life insurance policies. Because let's say hypothetically you're married, you get a divorce, you get a new husband, you have been married 10 or 15 years, something happened to you, but you never change your beneficiary. Your ex-husband will get that life insurance money. So make sure that you stay up on those beneficiaries. In addition to that, you also want to stay on top of your contingent beneficiary. What that is that if you have, whoever you have, if your life insurance person, if that person dies, you and that person together, and y'all both die, then that policy would go to the next person in line. So make sure you always name the contingent beneficiary in your life insurance policy. Next slide, Don. All right, is there any questions about life insurance?
Yes, we have a couple of questions. The first question is, how do you go about getting a policy on an elderly family member who does not believe has life insurance?
Well, one is that whoever you're taking, whether not just elderly, but anyone that you're taking life insurance out on has to agree to you taking the policy out. My recommendation would be if it's someone elderly, I probably would consider taking out a burial policy, and you can get those through your local funeral home. And it's not really life insurance on that side because you're actually paying for the funeral in advance, but you're getting it at today's rate. There are a couple companies, Lincoln and a couple other companies out there that do offer life insurance for the elderly. We actually have a product to offer to anyone, even including people with cancer. However, the max on it is $20,000. It has a 3-year contestability. Well, it's not really contestability, in waiting period, which means that if the person dies within the first year, we would only pay you back the premiums that you paid. If they die within the second year, we'll pay you your premiums plus 10%. And the third year, we'll pay you the face amount of policy.
Okay, thank you. And one other question that's related to the umbrella insurance. It says, could these policies be used to cover multiple rental properties?
Yes, what you have to make sure that you do is list those. And in the application of doing an umbrella policy, it will ask, are there secondary properties and things of that nature? So they would, yeah, you could utilize those. However, make sure, well, the liability limits of insurance on each one of those properties has to be $300,000. And one additional thing that I did not cover when I talked about an umbrella policy, most insurance companies will not allow you to have an umbrella policy or cancel your umbrella policy if you have accidents and things of that nature. So there's a period when you first get the policy, they want to make sure that you have a clean slate.
Okay, thank you. And just the last question for this category, with term life insurance, using your example of HB, would you have to update your insurance if your health condition changes after you bought the insurance?
No, it's at the health conditions is at the time of the policy. And I'll answer that in two folds. One, if you did a paramedic and your health changed, then you got that policy based on your condition at the time of you taking out the policy. If you took out a simple product and at the date of the application, you did not have this illness, but developed it thereafter, the insurance company will look back and find out when you were diagnosed with that illness.
Okay, all right, thank you. No more questions in the chat.
Okay, Dawn, let's go back to the final slide. Dawn, there we go. All right, so the main takeaways that I want you all to get from this presentation is the importance and understanding of retaining and relinquishing risk. So my challenge to you is to look at your policy, think about in the event of a loss, how an insurance company is going to perform. I want to make sure that you have a clear understanding, again, how your insurance will perform in the event you have a loss. It's too late when something happens to wonder if it's covered. That's something that I clearly recommend that you understand and know if it's covered. Make sure that you have the necessary conversations with your loved ones about wills, final wishes, etc. In the event, being that life is so uncertain, in the event something should happen to you, make sure your family clearly understand what your final wishes are, where your life insurance policy is located, who is it with, what what your will is, who you're giving what to, and the final wishes. Too often in our community, this is a conversation that we do not have. I know growing up in my family, we didn't have it. So I do challenge each of you all to have these conversations. They're difficult conversations, but having with your family, have a clear understanding of what your final wishes are. I want to thank you all for giving me the opportunity to present to you today, and I turn it back over to Tamara.
Thank you so much. It is my pleasure now to introduce Dawn Edgerton Cameron. Give me a second. I will open her bio and do that. Dawn spent the first 25 years of her career at companies such as McCormick and Company and Coca-Cola, listening to consumers, learning about their needs, and developing strategies to meet them. She now applies all of those skills to partner with people just like you and me to develop and maintain an investment strategy that controls what we can, prepares for what we can't, and builds trust that you have a reliable guide along the way. Dawn holds an MBA from the University of Michigan at Ann Arbor and a bachelor's in biology from Brown University. On a personal note, I first met Dawn through a mutual friend and colleague and was thrilled to meet someone who not only looked like me in this industry, but who was able and willing to wade through all of the issues and hangups I had with preparing for my financial future. Please join me in welcoming Dawn as she talks about 5 important money questions for women. Dawn, I'll turn it over to you.
Sorry, want to make sure I'm off mute and that I share my slide. So thank you for such a warm introduction, Tamara. I appreciate it. And thank you to the coalition for having me. I want to give you a couple of heads up in case of any tech diffs. You have my slides in your possession in the PDF labeled note taking. I'd ask you to have your participants workbook handy because this is going to be kind of interactive. If I were giving this in person, I'd ask you to shout things out, but since we're on Zoom, you can put them in the chat. First, can everybody see my title slide, 5 money questions for women?
No, we see you, Dawn. You need to flip the presenter view and the slide view.
Thank you. Okay, hang on a second. I'm going to do it this way. Let's see. Let's see. How's that?
Yes.
Outstanding. All right. So good evening. Thank you very much for having me. I appreciate the coalition's invitation and it's great to be here with you. As Tamara said, I am Dawn Edgerton Cameron. I am a financial advisor with Edward Jones in Severna Park, Maryland, which is near Annapolis. I've been investing for 25 or so years, and I've worked for Edward Jones for since 2018. And I became a financial advisor because I have a passion for meeting people, learning about what's important to them, and then setting strategies to help them achieve their goals. And that's actually a big reason I agreed to present to help you become educated investors. The part of my job I enjoy most is helping my clients achieve their goals, because it's an opportunity to literally change lives. And to accomplish that, I have to get to know my clients and understand the financial goals as well as possible. Let's see if I can get my slides to cooperate. Okay, great. As you know, and as Xavier so eloquently mentioned, it's an ever-changing world. Technology is always finding new ways for us to connect and communicate and live longer. And while these are exciting times, it can also be a little bit overwhelming. There's a wealth of financial information out there and quite a bit of noise. So I've joined you tonight because I think there are some unique challenges and opportunities for women when it comes to investing. And I want to help you cut through the financial noise. So I'm going to share tonight the 5 questions you should ask yourself to help you connect to your financial goals. Hopefully you'll leave here feeling a little bit better about your financial direction. Now, here's where the workbook comes in. If you turn to page 3, we can get started playing a quick game of fact or fiction. So I'm going to read a statement and you can either circle or type in the chat whether you think each statement is a fact or a fiction. So let's go. Fact or fiction? Nearly 70% of women are confident in how much they're saving for retirement. Do you think that's fact or do you think that's fiction? As part of our discussion today, I'm going to share 5 questions you should ask yourself to connect to your financial goals. The first of these steps, which we'll discuss in more detail in a few moments, is to evaluate where you are today. In other words, it's difficult to determine your financial goals, a strategy to pursue them, and whether that strategy is achievable if you don't first understand where you are today. So keep that in mind as you're thinking about the first statement. Circle the answer on page 3 of your workbook. Question 2 touches on another one of the 5 steps to taking control of your financial life. That's the strategy. Women may have many unique considerations in determining an effective strategy to work towards their goals. For instance, historically, many women have left the workforce for a time to care for either young children or aging parents. So here's the next fact or fiction statement. Women are about 8 times as likely as men to report they have work interruptions due to caring for their children. Do you think that's fact or do you think that's fiction? Think about it. Circle on page 3. FYI, in this mode, I can't see your chat. So if anyone wants to shout out, that's great when we get to that point.
Okay.
Sorry. What was that?
No, keep going. I thought you wanted the shout out now. Keep going. We'll wait for the shout outs.
Okay. Statement 3, things change. That's why it's important to review your strategy regularly to make sure it's on track with your financial goals. So here's the last fact or fiction statement. Nearly 40% of women are the primary breadwinners in their family. So now let's see how you did. First statement, do we think that 70% of women are confident in how much they're saving for retirement? Do we think that's fact or fiction? What do people think?
The consensus seems to be fiction.
Okay, well, the consensus is right. Unfortunately, only about 51% of women say they're confident in that they're saving enough to be able to retire comfortably. And that compares to 68% of men. Not great on either side, but notice we're trailing. If you don't have a well-defined goal, it makes it that much more challenging to work toward it. And that's why I recommend setting what I call SMART goals. And we'll talk about that more in a bit. Question 2. Do we think that this is fact or fiction? Women are about 8 times more likely as men to report that they have had work interruptions due to caring for children or aging parents.
Survey says fact.
Survey is right. Y'all are good. This is a fact. Women are, in fact, 8 times more likely than men to look after sick children or manage their children's schedules, which takes time out of their workday or other responsibilities. This could be a changing dynamic in many families, but the time away from the workforce often results in women accumulating less money towards retirement or other financial goals. And this is yet another reason why having an effective strategy in place is so important. Now let's check out our final fact or fiction statement. Do we think that 40% of women are the primary breadwinners in their family? Do we think it's fact or fiction?
We actually had votes for each.
Good debate, healthy. As it turns out, it is fiction, but that is because 54% of women say they are the primary breadwinners in their family, including 30% who are married and generating more than half of the household income. So these facts and fiction start to illustrate just a few of the important things to consider as we open our conversations today. One of the reasons some people don't get started putting together a financial strategy is that there are so many things to consider. And let's face it, we're busy. It can seem overwhelming. But if you feel that way, know that you're not alone. By joining us today, though, you're taking steps in the right direction, so please take a minute and pat yourselves on the back. If there is only one thing I can impress upon you this evening, I want you to remember this important advice. Please do not wait until you're forced to take responsibility for your financial future. Putting off thinking about and making decisions about your long-term financial goals is basically giving up control. This discussion tonight is designed to help you get started, and hopefully you'll walk away with the knowledge that there is help out there, and that even though the financial world can seem a little daunting, there are steps you can take to cut through the clutter. So let's start digging into what I referenced during our fact or fiction exercise, which is the 5 questions you can ask to connect to your financial goals. Though your needs and the person in the next block to you may be very different, I use these 5 questions as part of an established process. They help my clients define their long-term financial goals and build a strategy. And by understanding some of the concerns you need to consider, you'll be better positioned to build and adjust your strategy over time. You'll find these 5 questions on page 4 of your workbook. We're going to discuss them in detail, but here's how they're related. To have a clear outlook on your future, your first step is to evaluate where you are today. Only then can you begin to set clear and measurable goals for where you'd like to be. When your goals are determined, it's time for the reality check. If you make sure your goals are specific, measurable, achievable, relevant, and time frame, or what I like to call SMART goals. No, I did not coin the phrase, but you'll be better equipped to determine the strategy. This determination is based on the amount of time you have to invest and the investments you're comfortable with. These are known as your time horizon and your investment suitability. A trusted financial advisor can help you decide what tools and strategies can help you work towards your goals. And knowing more about the tools and strategies available to you, you can help make more informed decisions about where your money is going and what it's doing for you. You can stay on track by periodically evaluating where you are, whether you've reached your goals, and what new goals you'd like to achieve. If your current strategy is working for you, great. If it's not, you can make adjustments. I'll be taking questions at the end, so please write down anything that comes to you on page 15 of your workbook. So we talked about question 1, which is, where are you today? In other words, you need to understand your current financial situation. A lot of people have a general idea of where they stand financially, but it's important to have a clear understanding of your complete financial picture. Think of it like GPS in your phone or in your car. If you're looking for directions to get from here to there, you have to have a very clear understanding of where you are. Where is here? And the more precise you can be about your location and your destination, the more likely Google Maps or whatever tool you're using will be able to give you the directions you need. Let's do a short quiz in your workbook on page 5. It's 8 true or false questions. Take a moment, read through the questions, and circle true or false for each statement. I'm not going to ask you to share with the group, but this will begin to help you understand the types of information you should consider as you ask yourself, where are you today? I'm just going to take a look at the timer and give you a few seconds to take that quiz. If you don't finish it in time, obviously this is your workbook. You can take it later, but I encourage you to have this conversation with yourself. It's going to wrap up in about 5 seconds. Don't overthink any of these questions. Okay. I know that wasn't a ton of time, but in the interest of everyone's evening, I want to make sure I keep moving through the material. Again, if you didn't have a chance to finish this now, please go back and do it later. If you answered false to any of the questions, you can use that as an action item to help you during this process. So question 2, where would you like to be? Now, many of us have a monthly budget. If you don't, again, as part of knowing where you are, I strongly encourage you to create one. It helps you to understand your current financial situation, where the money comes from and where it's going. And then we need to decide what you want your money to do for you. So we're going to talk about understanding where you'd like to be and each of it being unique to you. But why? Because it's unique to your values and goals. So here's a good analogy to understand the difference between the two, at least when it comes to your finances. Again, we can all agree that technology moves quickly these days. It seems like a new smartphone is coming to the market almost every month. So let's say you want a new phone. You might have several reasons. Maybe your current phone is outdated or the screen broke. Maybe it doesn't have the features you want to keep up with communication with your friends or your kids. Or maybe you need a longer battery life to keep up with your busy lifestyle. In this simple analogy, your goal is to purchase a new phone. The value to you is, what reason is this important to me? Values are about beliefs, and they should drive your goals. Goals are tangible things or experiences that carry a specific monetary value. For instance, a goal might be paying down debt or buying a house or traveling. The values, on the other hand, are intangible and don't have a specific monetary value. Could be freedom or security or making a difference. A deeper understanding of your beliefs will help you as you make decisions about your long-term goals. Now, at this stage of your life, you might feel like you don't know what the future holds, and that's okay. The important thing is to understand your values and use them as the guide as you set your goals. Let's put some of this knowledge in motion. On page 6 of your workbook, you'll find some examples of common values and goals. This exercise is important because the definition of your imagined life reveals your values. What is most important to you? Those values should serve as a foundation for your financial roadmap. So what is important to you? Take a minute and imagine a life where you have met all of your financial goals. What does it look like? How do you feel? What words would you use to describe your perfect life? Turn to page 6 in your workbook. Take a couple of minutes to describe your imagined life. What qualities define that life for you? Maybe something like financial security or freedom from worry or whatever is special to you, but try to identify at least 3 qualities. Again, I'm going to set 30 seconds. Don't overthink it. Go with your gut. All right, take a few more seconds. Would anyone be willing to share their thoughts in the chat? Again, Tamara, if I can ask you to actually let me know what they say, that would be great.
I'm monitoring the chat. Anybody have values that they're comfortable sharing or goals that they're comfortable sharing? Family, freedom, and helping others. It's a great goal, Corlin. Anybody else want to share?
Okay, well, thank you, Corman, for sharing. Y'all can get the idea. Maybe some of you are still marinating on this, and that's fine. But once you've identified your values, you can start to break them down into specific goals. Everyone has different variables to consider as you each pursue your individual financial goals. And though this is the case, we tend to see some common primary financial needs that rise to the top in most people's goals. They include preparing for retirement, living in retirement, paying for education for a child or even a grandchild, planning for the unexpected, a job loss, a disability, another type of emergency, or planning your estate and inheritance. Now, some of these goals might sound familiar to you. So let me introduce you to Denise to bring them to life. We're going to talk about her situation and several of these goals that were important to her at different times in her life. Now, keep in mind, we made Denise up. She's not a real person, so nobody say, oh, I know her. So Denise, let me give you a little background on her. She is the oldest of 3 children. So personal responsibility and self-reliance have always been important values to her. She has a passion for helping other people find their passions. So as a result, she's worked to build a successful career in human resources. She married in her 20s, but she and her husband eventually grew apart and divorced in her early 30s. She's recently remarried and has transitioned jobs. As Denise's life has changed, her goals have evolved as well, and her values have consistently helped drive those goals. We're going to talk about that more in depth as the conversation continues. So let's go back, as Aretha said, let's go on way back when. Several years in Denise's situation to understand one of her financial goals, an emergency fund. When Denise was in her mid-20s, she read that financial experts generally recommend having an emergency fund worth at least 6 months of living expenses. So over a period of several years, she established an emergency fund and then worked towards other financial goals. Thankfully, this fund came in handy when Denise was laid off from her HR position 2 years ago, because she had to dip into this fund for a time to keep things running. But she was fortunate and found another job after only a few months. Because Denise values personal responsibility and self-reliance, she set her top financial goal at that time as replenishing the $6,000 she had to use from that fund. Denise reviewed her budget and set her goal, and then she needed to ask, can I get there? Once you know where you are and where you want to go, the next question to ask is, can you get there? It's your reality check. One of the best ways to help you answer this question is to make sure the goals you determine pass the SMART test. So if you look at page 7 on your workbook, you can take a look at what makes a goal SMART. S stands for specific. What exactly am I going to do? Let's go back and talk about Denise. In order to get a better understanding of what a SMART test. As you recall, she needed another $6,000 to make her emergency fund whole after using a portion of it during her job transition. She updated her budget worksheet along with her income from her new job as VP and employee relations. She also updated her monthly expenditures and her other financial information. Now she had a better idea of how much she could afford to contribute to the fund each month and how long it would take her to reach her goal. M is for measurable. In other words, how will I know when I've gotten there? Rather than put away random amounts in an emergency fund, Denise had a specific target, $6,000, against which she can measure her contributions. A is for achievable. Is it possible? Denise could look at the figures in black and white to figure this out. For Denise, the $6,000 figure seemed like a big number. It was challenging, but it seemed a little more manageable as a $350 a month contribution. She estimated that by making some changes to her lifestyle, like taking her lunch to work and renting movies rather than going out, and waiting to buy a new car, she could set aside $350 per month for an emergency fund. R is for relevant. Will it lead to a meaningful result? Will anyone care if I did it? Setting aside money each month directly impacts her financial security, which reflects Denise's values of self-reliance and responsibility. Things keep coming back up to her values. So this goal was extremely irrelevant to her. Finally, T is for time frame. When will she accomplish her goal? Denise determined that by contributing $350 a month, she could reach her goal in about 18 months. She realized it would take her longer if she couldn't contribute the entire amount each month, or she decided not to invest. And she also realized that she could reach the goal more quickly by increasing her monthly contribution or by earning a better rate of return. Once Denise confirmed this was a realistic goal, she started to map a strategy and put it into action. Now, your financial advisor, if you have one, can help you with this process. In Denise's case, she replenished her emergency fund and was able to move on to her next financial goal. So you can see, how do I get there is more than just developing a strategy. It's also about actually executing on that strategy and putting it into action. There are few guarantees when it comes to life, but one thing you can be sure of is if you never start working towards your goal, you won't achieve them. In other words, plan the work and work the plan. Your overall strategy should help you plan for the expected by understanding the concerns associated with the goals you choose, taking the steps to work towards your goals, and learning ways to balance potentially competing goals. And prepare for the unexpected by being aware of unexpected events that can derail the strategy. You need to position your portfolio for both by addressing the expected and unexpected while balancing potential issues and trade-offs. So why is it important to get started sooner rather than later? The reason is that time plays a critical role in working towards your financial goals. To explain what I mean, I'll use a quick tool that illustrates how savings can grow over time. This is an easy calculation. There's no need to reach for your smartphone. You won't need a calculator. And then pop in the chat. Has anyone ever heard of the rule of 72? I'll take that as a no. Well, it's a general investment rule of thumb that assumes the investment's principal value and rate of return remain constant, and that all interest and or dividends are reinvested annually at the same rate of return. If you turn to page 8 of your notebook, I'll talk you through why it's important. Bottom line, this rule tells you how long it'll take money to double. Here's how it works. Divide 72 by your rate of return. The number you get equals the approximate number of years it takes for your money to double. So there are a couple of examples in your workbook on page 8 to illustrate how the tool works, but we're going to work through one together. Now, if your rate of return on an investment is 4%, you can quickly figure out how long it'll take for your money to double. Anybody have any ideas? 72 divided by 4 is 18. It works the same way if you're trying to figure out what rate of return you need over a given time frame. If you know you have 12 years to reach your goal and you need to double your money during that period, then your rate of return needs to be 6%. So you can see the relationship between an investment's rate of return and time. In other words, the earlier you can get started, the less dependent you'll be on getting a specific rate of return to achieve your goal. Let's go back and talk about Denise. It's a few years from our last visit. She's a few years into her new job and she's doing well financially. And she has some other exciting news. She's recently gotten remarried. Paul and his 6-year-old daughter, Bree, are the center of her life. Denise is thinking about her financial goals again, and she realizes Bree's going to be headed off to college before they know it. So Denise and Paul want to make sure they're saving enough for Bree's higher education. So let's use that rule of 72 again to get a rough estimate of the impact time plays on a financial goal. We're going to keep it simple and say Bree is going to start college in 12 years. And let's say Denise and Paul have about half the money they need to meet their goal of helping Bree with her education costs. So what rate of return will be required to meet the goal? Anybody want to pop anything in the chat? 72 divided by 12 is 6. Now, let's consider what will happen if they wait to start investing until Bree is 12. They'll only have 6 years to double their money. So the rate of return that they'll need will be 72 divided by 6 is 12, a much more aggressive number. So you can see from that illustration, one reason it's important to get started sooner rather than later. As a result, Denise and Paul sat down with their financial advisor to look at savings options for Bree's education, including 529 college savings plans and other investment options. This example illustrates the importance of time, but it also shows why it's important to choose an appropriate strategy for your needs. For instance, putting all your money in a savings account or a certificate of deposit, CD, or some other short-term investment may not be the most cost-effective, may not be appropriate for money that needs to be, or may not be the most cost-effective way to work towards your long-term goals. Savings accounts and CDs are appropriate for money that need to be readily available, like an emergency fund, but it may not offer the type of return appropriate for long-term goals. And that is an important consideration as you develop your strategy. In terms of saving towards a goal, there are several ways to get started. So let's talk about a few of the tools you can consider. Has anybody ever heard the advice to pay yourself first? Well, that's a great way to get started. While paying bills each month, write a check to your savings or investment account. If you want to stay disciplined about investing, consider setting up an automatic withdrawal from your checking account into your savings or investment account. This strategy of investing a manageable amount regularly is called systematic investing. With systematic investing, it's all about the 4 C's: convenience, consistency, choice, and control. And those are all spelled out on page 9 of your workbook. In terms of convenience, systematic investing helps you get started by making your investing automatic. Once you decide on a fixed dollar amount to invest on a systematic basis, you've taken procrastination out of the equation. And since you don't have to think about it month to month, you can cross several things off your to-do list. It's built-in discipline. And with an approach of consistency, you're accumulating continuously and steadily, regardless of market movements. This helps take the emotion out of investing and eliminates the worry of trying to time the market, because that's a fool's errand. With the systematic investing program, you have the choice, 3rd C, to invest in mutual funds, annuities, individual stocks, and other options. And lastly, systematic investing allows you to focus on what you can, 4th C, control, which is investing in a set dollar amount on a regular basis, rather than what you can't, which is volatility in the market. Now, systematic investing cannot guarantee a profit or protect against loss, but it can make you more disciplined about your financial strategy. Now, if one of your financial goals is preparing for retirement, like a lot of us have the same goal, it's important to consider employer-sponsored retirement plans. Does anybody have an employer-sponsored plan like a 401k or a 403b or a TSP? And if you do have it, do you contribute? First of all, if your employer offers a retirement plan, please make sure you're taking advantage of it. It's also a good idea to find out if your employer will match your contribution and how much you'll need to contribute to obtain the full match. Not contributing at a level to get the match is like leaving free money on the table. Also note, you do not have to plan to retire from this job to take advantage of employer-sponsored retirement plans. They are portable. If you've ever heard the term rollover, that's what that is. Depending on your situation, you might want to consider other alternatives for the rest of your retirement dollars. Even if you do have an employer-sponsored retirement plan, an individual retirement account or IRA is another savings vehicle to consider. Traditional and Roth IRAs are both designed to help you save for retirement, but with different approaches. We'll talk more about them in just a moment, and you can read more about it in the flyer that Tamara emailed out to you called Choosing the Right IRA. Now, here's what these 2 IRAs have in common. Traditional and Roth IRAs allow you to invest your money in a variety of vehicles. You can select the investment mix best suited for your goals and life stage. For example, you might choose investments in your IRA that are more oriented towards growth when you're younger, but as you approach retirement, you might start shifting to more conservative investment vehicles. There are, however, some differences between the two types of IRAs, and those are on page 10 of your workbook. A key advantage of the Roth IRA is that you can withdraw your earnings tax and penalty free as long as you have reached the age of 59 and a half and have held the Roth IRA for at least 5 years. Unfortunately, not everybody can contribute to a Roth IRA because there are income limits. However, there are no income limits if you choose to convert them. So if you choose to convert from a traditional IRA to a Roth IRA, the longer you can delay paying taxes, the better potential to accumulate more retirement savings. Now, although a traditional IRA doesn't offer the benefit of tax-free withdrawals, contributions to a traditional IRA can be tax deductible depending on your income and whether you or your spouse is covered by an employer-sponsored retirement plan. These are just a few strategies to help you reach your retirement goal. The right strategy for you will depend on many factors such as your income, your age, and what you plan to do in your retirement. Before deciding on any of these options, you should discuss your situation with your financial advisor and your tax professional. If you'd like to learn more about the power of tax deferral, please take a look at the handout that I've included in your packet today. The most important thing to remember is to start now. If you think it costs to save, consider how much it costs for you to wait. Turn to page 11 of your workbook for an example. And let's get back to Denise. Well, Denise and Paul. It's just a few years later, and they're looking at another goal, preparing for retirement. Time flies. Bring you up to speed, Bree's just a few years from going off to college. Denise and Paul are getting close to meeting their goal of doubling their money that they want to use for education. They're now 40. Denise keeps their budget worksheet up to date and decided to sit down with their financial advisor to talk about her vision for her retirement. During the conversation, they determined that she needed to invest $5,500 per year or about $458 per month in her IRA to reach her retirement goals. Denise would like to retire when she's 65, so at age 40, she's got 25 years to save. If she invests $5,500 per year and earns 7% annually, she will have saved more than $434,000 for her retirement. If she waits until she was 43 to start investing, remember she's 40 now, her account when she retires will be worth about $344,000. A mere 3-year delay costs her more than $89,000. For comparison, if she'd started investing $5,500 a year when she was age 30, she'd have accumulated more than $906,000 by the time she reached age 65. These calculations assume that Denise is going to make those $1,000 catch-up contributions she can make when she's reaches age 50. But on page 11 of your workbook, it spells out in a clear bar chart the difference in the cost of waiting. Now, remember, I mentioned earlier, you need to have a strategy, but the best strategy in the world is no good if you never get started. The biggest mistake people make when it comes to investing is not getting started. So please don't make that mistake. Question 5 is, how can you stay on track? Now, once you have your strategy in place, reviewing it is probably the most important part of this whole process. For better or for worse, life is full of surprises. Be diligent in your effort to update your budget worksheet regularly and revisit your financial strategy. For instance, your child might get a full scholarship or decide to go to medical school. Both are great, very different financial impacts. Or you might experience a loss in the family or a divorce. As your situation changes, be sure to review your strategy to make sure you're still on track. Now, we've covered a lot of ground today. You can always turn back to page 4 in your workbook to see the 5 questions and follow along. But the most important thing I can leave with you today, again, is please do not wait until you're forced to take responsibility for your financial future. Putting off, thinking about, and making decisions about your long-term financial goals is essentially giving up your control. And as you start thinking about your financial goals, there are 5 questions you can ask to help link you with those goals. Those questions, once again, are: where am I today? In other words, gain an understanding of your current financial situation. If you'd like a budget worksheet to help you during that process, please reach out. Question 2, where would I like to be? What are your goals and dreams? Understand the difference between your values and your goals, and use your values to help chart the course. And then you can start to break them down into specific goals. 3, can I get there? Determine if your goals are realistic by giving them the SMART test. 4, how can I get there? In other words, what's your strategy? You can use tools such as systematic investing and employer-sponsored retirement plans to work towards certain financial goals. 5, how can I stay on track? Though it didn't take us long to address this evening, it is one of the most important aspects of your overall strategy. Regular reviews are key. Now, earlier, I asked you to think about how you can translate one of your values into SMART goals. I want you to take that goal and plan something you can do now. Take a look at page 12 of your workbook, and there's some simple suggestions for things you can do in the near term. It's near the holiday season, which means resolution season is right around the corner. On page 13, you can record your own action plan. For example, in the next 48 hours, you could commit to setting aside some time to review your household finances. Put a calendar reminder in your phone or mark your calendar to help make this a priority. In the next week, you could gather all of your financial accounts and statements. In the next 2 weeks, you can complete a monthly budget worksheet. Use an Excel spreadsheet. Ask me for a copy of our sheet. Whatever tool works for you. In the next month, you can schedule an appointment with a financial advisor to translate that information to some realistic goals so you can develop strategies that make sense for you. In the next 3 months, you can start putting your strategy to action. Or if you're a resolution person, you can start in January. In a year, you can review your strategy to see if you're on target to reach your goals or if adjustments need to be made. Remember, the sooner you get started, the better. Now, at this time, I'd like to take your questions. Please note, due to time, I'm not able to dive into specific personal questions about your unique situation, but if you contact me, I'd be more than happy to set up an appointment. We can discuss your goals and your needs one-on-one. I'm going to see if I can exit out of this and see your smiling faces.
Thank you so much, Dawn. We do have a couple of questions. We'll take the one that's in the chat first. People want to know if, for those of us who have had life happen to us and we're in our 40s and we're now looking at retirement and we're like, what do we do? Is it too late for us? What can we do to either get started or catch up?
Absolutely not too late. Life happens to everybody. Nobody's perfect. If the situation is perfect now, I'm sorry to be Eeyore, but wait a minute, it's going to change. I tell my clients this all the time. You're 40. It's not just important to get you to retirement, but we have to get you through the rest of your life. Particularly, women tend to live longer. So if you're 40 now and you live till 90, that is still 50 years that you can save and grow for your financial goals. The key is to get started now. I can work with you to develop a catch-up plan, but if you never make that call, I can't help you.
Okay. The next question was about the rule of 72. So when you figure out what the rate is, doing the math, are you assuming that that rate is steady state for that period of time? Because that rarely happens. So I'm wondering, like, does it really work?
It works as a rule of thumb. It
Okay.
is not precise. And again, I see someone in the chat that says, I love a good spreadsheet. My husband's got a spreadsheet that's like multi-tabs and he calculates the rates of return for the past, I don't know how many years. This rule of 72 is not that. It is a rule of thumb. It is designed for you to say, hey, if I have an investment portfolio and I've gotten 8% on average between 2010 and 2021, the rule of 72 says it would take me 9 years to double my my balances. Rule of thumb, not a precise tool.
Okay, and then the last two questions have to do with employer plans. So it's kind of two sides of the same coin. If your employer doesn't offer a plan, how can you invest and start saving on your own? And then the other question is, you mentioned if you don't participate like to the level of the match, you're basically leaving money on the table. Well, if you can't afford to do that, should you still go ahead and contribute to the plan?
I'll take the second one first. If you cannot afford to contribute as much as you can to get the match, contribute as much as you can afford. Pay yourself first. Also, if you're working with a tax professional, ask him or her his insights, because I can give tax education, but not tax advice. Ask him or her what the net benefit would be if you did contribute to your employer-sponsored plan on a pre-tax basis. In my experience, that money, because it does come out pre-tax in traditional 401k plans, it's either going to you, future you, or the tax man. So in my experience, if you get into a new job and you max out your 401k, you usually don't see it because it was going to go to the tax man anyway. If you don't have an employer-sponsored retirement plan, first of all, ask your employer if you can get one. Or in the meantime, use your individual retirement account as much as you can. Individual retirement account. It's not tied to an employer. You can go to a financial advisor. You can go to a broker, an e-broker if you want, if you don't have any need for support, and open up your own IRA, either traditional or Roth. Choose what's best for you. If you're under 50, you can typically contribute $6,000 a year. Those of us that check the over 50 box get an extra $1,000. Again, there are tax implications to each. Work with your tax professional to make sure you are making the right choice for you, but there is absolutely a lever you can pull. You also can put money in a non-qualified, in other words, a regular brokerage account if you have extra money lying around but don't have an employer-sponsored plan. There are things you can do. Don't wait for somebody else to help you.
Okay, thank you so much, Dawn. Xavier, I have one question for you that came in. So you were talking about the umbrella policies, and what's the difference between an umbrella policy and, like, you see all those commercials for combining, like bundling your home and auto? Is that the same thing?
No, that's just to qualify for multi-policy discount. Umbrella policy is aggregate limits above your liability limits. So remember that having the 100, 300, well, on the umbrella policy required, if you have 250,000 for the first person, 500,000 total accident, the umbrella policy goes in excess of that. So after the $500,000 is exhausted, then the umbrella policy will kick in.
Okay, and then the other question that came in was, in terms of life insurance types specifically, we've heard that certain types of life insurance policies can be cashed out early to do things like, pay for a kid's wedding, college contributions. Which type of insurance is that, number one? And number two, is that ever a good idea?
Well, that's whole life insurance that does accumulate cash value. My recommendation would be to, if you're looking at to accumulate wealth with life insurance, those are two different vehicles. And you probably want to get with an insurance agent that's also licensed to do investments, or either I talked to Dawn earlier, she doesn't do that, but some investors do the one that has a life insurance component with an investment account. But on the regular traditional life insurance policies, yeah, they do accumulate cash, but the only way, you'll have two options in terms of getting that cash. You have to borrow against the cash, or you have to surrender the policy in order to get the cash out of it, which is, always remember, life insurance is never designed It's not designed to pay you. It's for your beneficiaries.
Thank you. Do we have any other questions from our participants? If so, if you could put them into chat, that would be awesome. And as we're thinking about wrapping up here, Xavier and Dawn, I want to thank you so much for all of the wonderful information that you've presented to us tonight. We've had so many wonderful comments come in on the Facebook feed and in the chat about, the level of detail of the information and how useful this has been. So we very much thank you for your time and the effort that you've put into this presentation this evening. For those who are still with us, we have put both Dawn and Xavier's information in the chat. You can contact them directly. Please do reach out to them, show them some love. We also are gathering feedback on this workshop. If you could hit the survey link that's also in the chat, that's awesome. We would very much appreciate it. That will also be coming out as a thank you for attending. But if you want to get it done now, so you don't, while it's fresh in your mind, that would be wonderful. Yvette or Jackie, is there anything else that we need to cover tonight before we close out?
I do not have anything additional. I also want to thank Dawn and Xavier for participating in this webinar. And thank you to all the participants as well.
Good evening. I just want to thank Dawn and Xavier for your participation. And I greatly want to thank Tamara and Jackie for putting this webinar on. This was excellent. It provided great information that I'm sure everyone can use. I have nothing else to add to this webinar, so you can close out, Tamara.
Thank you so much, everyone, for your participation, and we hope to see you again soon in our next one.
Thank you and happy holidays.
Have a happy holiday season, everyone.